Hi friends, in this video we are going to discuss about capital budgeting decision. Okay, this is actually an important area which is coming under business finance module. So we will discuss about the NTA previous year questions from the area of this capital budgeting decision, and we can have an overall idea about this particular area. So when you are considering the NET UGC NET exam, you can see that in every exam, when you are taking any NET exam, you can see this question, a question from this particular area for every exam. Okay, just consider this October 2020 exam. In this exam, shift 1, from shift 1 we know that commerce is actually conducted in 2 shifts. So in shift 1 we have one question from this area that is actually about net present value and IRR, and in shift 2 you have 2 questions from this area. The first one is about the steps in capital budgeting process, and another one is actually from payback period. Okay, so similar way in every exam you can expect 1 to 2 questions, okay, maximum 2 question from this particular area. So see, this area is very important and it's a simple topic. Okay, so what do you mean by this capital budgeting decision? Capital budgeting decision is actually, we are taking a decision that is a long term decision. That means in a simple way you can say that whether you need to, you are evaluating certain investments and you are taking decisions upon your evaluation. So this is a process of evaluating investment and huge expenses in order to gain the best return on investment. So you may have different opportunities and you are finding, you are just valuing each return from each and every project, and based on that you are determining or you are choosing which project you should go for. So it includes the decision to invest the current funds for addition, modification, disposition or replacement of fixed assets. So this capital budgeting decision can be either to purchase a fixed asset or to dispose or to replace such kinds of items. Okay, so this process of capital budgeting, it's a process of planning. We are planning which is to evaluate the potential investment or expenditure whose amount is significant, as we know that a large amount of fund or huge amount of funds is actually involved in case of this capital budgeting. In a simple way you can say that capital budgeting decision is an investment decision, okay, like whether you need to choose project A or project B. That means if you have 2 opportunities, which one you should go for, okay, that such a decision you can take with the help of this capital budgeting. So for taking, like whether to go for project A or whether to go for project B, you should have some tools or techniques to take this types of decision. So that such a types of techniques is known as capital budgeting techniques. Okay, so coming to capital budgeting techniques, we have 2 methods. One is traditional method and other is modern method. So these are the 2 main classification in regards to the capital budgeting techniques. Okay, it's very important. The classification is also very important. So what do you mean by this traditional technique? Means this traditional technique which involves or which is not actually considering the time value of money. What do you mean by this time value of money? We know that the money that we are receiving today and the money received in future, when you are comparing its value, money received today is much more valuable when comparing to the money that you are going to receive in a future date. That if I am promising you that I will give you a rupees 1000 rupees now, and if I am promising that okay I will pay this 1000 after 2 years, see the value or the money that received today is more valuable because with now or by now I can purchase a lots of things with the rupees of 1000. Maybe after 2 years for the same product you need to give maybe 2000 or 1500 rupees. Okay, so here the value of money decreases as it passes time. So such time value of money is not actually considered in case of traditional technique. You can say that that is a main limitation of this traditional technique. Okay, so it is also known as non-discounting technique, as we are not considering the present value of future cash flows. Then it does not, it is also known as conventional technique. So that is another name of traditional technique, that is conventional technique. So you can call traditional technique as conventional technique or non-discounting technique. And the major feature which regards to traditional technique is that it is not considering the time value of money. Okay, and coming to the different types of traditional techniques, see we have 2 methods to calculate or to take a capital budgeting decision based on this traditional method. One is payback period, another one is average rate of return or accounting rate of return. Okay, so one is payback period, the other one is average rate of return. So this payback period is very important. Okay, its calculation all are very important. Anyway, you should know the classification based on traditional method. So we have two classification, that is traditional and modern. In traditional, we have two classification, that is payback period and average rate of return. Okay, and the next one is modern technique. So modern technique is also known as discounted techniques. Here we are finding the present value of future cash inflow. This is also known as discounting technique, while traditional method is a non-discounting technique. And the major feature of this modern value or modern method is that it considers the time value of money in such a way that it is more scientific and it is a time adjusted technique. Okay, that's another name. And the another important property of this modern technique is that it do considers all benefits and costs occurring during the complete life period of that particular project. All cash inflows, all expenses that particular company needs to incur for the purpose of accepting that project, all these will be considered if you are following this modern techniques. Coming to the classification of modern techniques, here we have net present value. NPV means net present value, IRR, internal rate of return, PI, profitability index, discounted payback, and finally net terminal value. Okay, and so see, this is a question which is asked in October 2020 shift 1. As I already mentioned, it is about NPV and IRR. See, NPV and IRR methods yields conflicting outcome due to option A, unconventional cash flows, option B, investment size disparity, option C, investment life disparity, option D, cash flow pattern disparity. So these are the different options, and yeah, you can choose either it can be AB, AC, ABC and BCD. So before going to a detail about this particular question, you should know what is NPV, what do you mean by IRR and all. So NPV, as we know that it is a modern technique, and here we are finding the difference between present value of cash inflow and present value of cash outflow. Okay, so this is actually the difference between present value of cash inflow and the present value of cash outflows. Here in case of net present value, we need to decide, or the management need to decide a cutoff rate, that is a minimum return that they are expecting by making an investment in a particular project. Such a rate should be determined by the management. Okay, so this is actually the equation for calculating net present value. That means just take the difference between present value of cash inflow and present value of cash outflow. See, this is very important, and the calculation is also very important. Many times they were asked for calculating this net present value. So the calculation is also quite very important. So we already uploaded lots of videos regards to these different types of capital budgeting in our LMS platform. Anyway, just see, so in a very simple sense we can say that net present value is actually the difference between present value of cash inflow and present value of cash outflow. Okay, so this net present value that actually showing, or it just shows the net addition, or how much improvement is actually giving to the wealth of the shareholders. Okay, that is saying about the wealth of the shareholders. Okay, wealth maximization concept is discussed here. And if you are following this net present value, how you will take a decision? See, you can compare the present value of cash inflow and present value of cash outflow. If present value of cash inflow is more, inflow means that you are getting, that is your return from the investment. If the present value of cash inflow is more in comparing to the present value of cash outflow, outflow means the amount that you need to make the investment. Okay, that is your expense. So the present value of cash inflow is more, you can accept the project. But if the present value of cash inflow is lower while comparing to present value of cash outflow, it is better to reject the project. So we are accepting or rejecting a particular project based on NPV with the help of this, making a comparison between present value of cash inflow and present value of cash outflow. If inflow is more, we will accept it. If inflow is lower in comparing to outflow, we should reject it. Okay. And the second one is internal rate of return. So that is IRR. So internal rate of return is the rate at which total of discounted cash flow equals to total of discounted cash outflow. So here in case of this IRR, we are finding a particular rate. At that particular rate, your present value of cash inflow and present value of cash outflow will be equal. Like it is in a break even. Both these will be equal. So at this point what will happen, your NPV will be 0, because NPV is actually the difference between present value of cash inflow and present value of cash inflow, right? We are taking the difference between present value of cash inflow and present value of cash outflow. But in case of IRR, we are finding, or we are taking, or with the help of this, we are finding a rate at which the present value of cash inflow and present value of cash outflow are equal. If they are equal, we know that there is no such a difference between this net present value of cash inflow and present value of cash outflow. Then at that point, if there is no difference, the present value will be, net present value will be 0, right? Internal rate of return is the rate at which the total of discounted cash inflow equals the total discounted cash outflow. That is the rate of discount which reduces the net present value of an investment to 0. Okay. So this particular discount rate is actually known as IRR, and you can see that at this particular rate what will happen, NPV will be 0 as there is no difference, and profitability index will be 1, because profitability index means it is showing the ratio between present value of cash inflow and present value of cash outflow. So such a ratio means both these values are equal, present value of cash inflow and present value of cash outflow are equal. So at that point when both denominator and numerator part is same, your answer will be 1. Okay. So these two are very important point. That means at the rate, at this discount rate, or at the point of IRR, net present value will be 0, and what is happening to the present profitability index, that is 1. Okay. And if you are going for this IRR, then how you will take a decision that whether to accept or reject a project? See, we have a required rate of return, that means a minimum rate of return. So we will consider it with minimum rate of return and IRR. Okay, and if you find IRR is more than that expected rate, you can go for the project. In this case of independent or single investment or project, if the internal rate of return is higher than required rate of return or hurdle rate, the project will be approved, or vice versa. So like if the return expected by the company is 10%, okay, and when you calculated IRR, you got a percentage like 12%. So your IRR is more than expected or desired. So you can accept the project. If it is happening in a reverse order, like if IRR is 10 and your expected rate is 12%, you should reject it. Okay, so this is the decision criteria that you have to follow in case of a IRR. So when you are considering both these NPV and IRR, both these are modern technique. Okay, as they are modern technique, both of them will consider the time value of money. Okay, so time value of money is the criteria in both the methods, and cash flow for the entire periods are considered. So for calculating this, we are taking the cash flows of the complete life of that particular like project will be considered in case of NPV and IRR. Okay, now when we are using both this technique, or when you are calculating with the help of NPV and IRR, the results may be confusing, because the result will give you like the results will be different. Okay, this is because of 3 reasons. Okay, or the conflicting factors, or the factors which conflict the results of calculating NPV and IRR is due to these 3 factors, like different initial investment, that is cost disparity. Different initial investment means the investment that we needed in a particular project is different, like for project A it is 10 lakh, project B it is 20 lakh. Like if there is a disparity in its initial investment, then unequal lives of project, and if you are taking 2 projects, its life period is different. For project A 5 years, for project B it's 6 years. So here the life period is different. Okay, in such case also your answer will be conflicting one. Unequal lives means it is life disparity. Then cash flow pattern and timing of inflow, that is a time disparity. If there is like any disparity in case of cash flow pattern, how this cash flow is actually happening, that means cash inflow, the return from that particular project. If the pattern is also different for different project, then also what will happen, the results from NPV and IRR will be conflicting one. Okay, so now coming back to our question, NPV and IRR methods yields conflicting outcomes due to, see, unconventional cash flows, investment size disparity, investment life disparity, cash flow pattern disparity. So we already studied all the concepts or all the factors, conflicting factors which leads to this difference in this NPV and IRR. This is a direct question. So which will be the options? option B, C and D. That means here B, C, D, that is option D. Okay. Now moving to another question again, which is on October 2020, shift 2. Sequence the following in capital budgeting process. A. Cash flow estimation. B. Identifying discounting rate. C. Project selection decision. And option D. Determination of NPV. That means this particular capital budgeting process is actually based on with the help of NPV, net present value. And we have the order which related to capital budgeting process. So see, capital budgeting process simply it is like whether you need to decide whether how you are taking or whether to accept a project or reject a project, or if there is two projects, which one you should choose. For that you have a number of techniques, right? So when it comes to its decision, the first thing is cash flow estimation. So cash flow means the return that you are getting from the investment. So that's an important thing. First of all, you are thinking about the return, how much return that I will get by investing in this particular project. So that's the first thing you need to consider. An integral part of valuation and capital budgeting decision is this cash flow estimation, and cash inflows from different projects are identified. You are identifying cash inflow from the different opportunities or from different projects which is available. So that's the first step. And what about the second step? You need to identify the discounting rate. Okay, now we know that here we are calculating which is based on time based. Time value is actually considered. So here you need to find the value, the future value, like future cash inflow to their present value. That means here you are considering, or here you are valuing your future cash inflow in terms of present value. Presently how much value is actually for that particular amount. So you are the discount rate is the rate of return to discount future cash flows to their present value. So you need to discount the value in order to find the present value of future cash inflows. That is the second step. And what about the third step? Then if you are following NPV method or whichever method, if I am just taking as it's a case of NPV. NPV is the difference between the present value of cash inflow and present value of cash outflow that we already discussed. NPV means it is actually the difference between present value of cash inflow and present value of cash outflow. So with the help of this NPV, we are calculating the difference between these two values. Okay, then finally project selection decision. When making a project selection decision, one with higher NPV is preferred. Like if it is a case, if the present value of cash inflow is more for both project, like if there is a project A and project B, when we calculated net present value, the net present value or it is positive for both the project A and project B. That means in both these cases there is a increased cash inflow. Okay, present value of cash inflow is more. In such a case, which project you will be choose? You have to choose the one with higher NPV value. Okay, like for project A maybe 3000, project B 4000. You should go for project B. Okay, so this is the way how this capital budgeting process is going on. Now coming back to our question, see here the first one is cash flow estimation. Yes, that is correct. Option B, identifying discounting rate. Then option C, project selection decision, and option D, determination of NPV. We know that selection is the final step. Okay, anyway C is the last step. When you consider the option, you can see that 3 options except option A, the other 3 options are ending with option C. Then which one will be the first option? Cash flow estimation. That's the first step. So just try to identify an option which starts with option A and ends with option C in such a way that you can directly go for option B, even though you can check it, like option A is the first cash flow estimation. Then the next one is you have to discount the rate. Then after discounting you will find net present value, and finally you are selecting the project. So A, then the next step is B, then D and C. A, B, D, C. That is option B. Okay. Now another question which is asked in December 2019. Okay. So yeah, the methods and its formulas are there. Okay. So the first one is average rate of return, then payback period method, net present value and profitability index. So the equation of different capital budgeting technique is also important. You should study the equation related to each and every capital budgeting techniques. Firstly, the first and foremost simple technique is payback period. That is a traditional method. So how you will calculate payback period? See, total investment divided by annual cash inflow before depreciation and after tax. So while you are considering the calculation of cash flow in case of payback period, you need to take the cash inflow before depreciation and after tax. That is very important, which type of cash flows should be considered in case of payback period. So total investment divided by annual cash inflow. That is a method for calculating payback period. Okay. Then what about ARR, average rate of return, average annual profit divided by average investment. If there is if the profit is given for different periods, you need to add them and you to divide it with the number of years. Okay, in such a way that you can calculate average annual profit. And if there is scrap value, okay, if there is scrap value in the question, you have to add it with the investment value and divide it with 2, then you will get average investment. Simple way, it can be calculated by average annual profit divided by average investment multiplied by 100. See, payback period means you are getting the answer in years. Okay, that means payback period means how much years is actually required to get back your or to recover your initial investment. Okay, so that's payback period. Then ARR. Now the next one is profitability index, which you can calculate by present value of cash inflow divided by present value of cash outflow. Okay, so it is actually showing a ratio between the present value of cash inflow and outflow. Okay, then net present value, as we already discussed, it is a difference between the present value of cash inflow and outflow. So present value of cash inflow minus present value of cash outflow. And the next one is net terminal value. For calculating net terminal value, present value of compounded sum minus initial investment. Okay, present value of compounded sum minus initial investment. Okay, the next one is discounted payback period. Payback period, the major limitation of payback period is that it is not considering the time value of money. So in modern techniques, it's revised such a limitation, and yes, in discounted payback period, we are considering time value of money. So that you can see in this option, like total investment divided by present value of annual cash inflow before depreciation and after tax. So the only difference is that in case of discounted payback, we are finding or we are discounting the cash inflow. Okay, so it will be divided by the present value of annual cash inflow. So the problems and different practice problem related to each of these areas is already uploaded in our LMS platform. Okay, anyway, the next, coming back to our question, see, the first one is average rate of return, accounting rate of return method. So A, which can be matched with, see, average income, average investment. Okay, from that word itself you can come to this particular point. So ARR method can be matched with option 3. So let's check how many options is with starting with A3, only 2 options. So you can eliminate the rest of option. It can be either option A or it can be option B. So the next one is payback period method. It is payback. Okay, payback means it is about the investment divided by annual cash inflow. Okay, the initial investment divided by annual cash inflow. If it is a case of discounted payback, then here you will have a word like present value of annual cash inflow. Okay, so B with 4. Yes, A3, B4. Now the correct option will be option B. Anyway, we can check. What about C? NPV is actually the difference, present value of cash inflow minus present value of cash outflow. So yes, C 1. And what about D? Profitability index. See, it is actually showing a relation or ratio, present value of cash inflow divided by present value of cash outflow. So ARR A 3, B 4, C 1 and D 2. Yes, the correct answer is option B. So in this video, we discussed about a very important area, that is capital budgeting decision. This is very important. You should go through the different techniques and you should know the equations and the calculation of NPV, then profitability index, then payback period. All these are very important you should practice questions from this area. You need to work out problems from net present value and all. So I hope this video will help you for your preparation of NTA UGC NET and JRF. Happy learning. Thank you.